so now we've talked about internal controls in general. We're going to take a quick look at controls specific to cash. So cash is highly susceptible to theft. Everybody wants cash. So if someone's going to steal something, they probably would most want cash because they can then spend it on anything. So cash is something that you need to be really careful with because everybody wants it. So when we talk about cash, it can be received or paid first as just bills or coins. So you actually physically have the cash. But checks also count as cash, and so do electronic funds transfers. So all of these are money that's come out of your bank, and therefore it's all part of cash. And you could receive or pay cash in person. So you actually go somewhere or someone comes to your place of business and the payment is made. They might mail it, or an EFT would just be done electronically. So the textbook breaks out cash receipts and cash payments. And those are two separate areas, so they would have different controls. Now you can read this on the slide and through the textbook, so I'm just going to go through it pretty quickly here. So if we look at the control activities, well, there's always going to be an assignment of responsibility and different authorization levels that are put into place. So I talked about a cashier each being responsible for their cash drawer. So only authorized individuals are allowed to operate that cash drawer. As well, you saw the manager had authorization for a return. So just breaking down who is responsible for what and who is authorized to actually handle cash. The segregation of duties will ensure that there's different individuals who record the cash from who handle the cash. Because if the same person is doing both, they can just steal the cash because they actually have access to it, and they would record something in the accounting records to show a reason for less cash. So you need to separate or segregate those duties so that whoever's handling it is not able to record anything in the system. Documentation, there's all different types of documents that could be used. So remittance advices, those are when you pay an invoice off. There's cash register tapes for cashiers, system reports from point of sale systems, deposit slips, confirmations. So all of these things are used when cash is received and put into the bank to help prove what amount there was and what type of or how much there was when it was dealt with. Physical controls would also be in place, so storing cash in a safe. Cash registers are locked unless a transaction's processed or a manager has a code for a return. So all of these are physical controls that help prevent someone from being able to take the cash. And you would also have various reviews and reconciliations in place. So we talked about this as well. Cashiers, they count their cash in their register at the end of the shift, but a supervisor would also count that and look over the receipts to make sure it was correct. Plus, accountants would eventually get those receipts and likely the cash deposit, so they would compare those as well to make sure the cash that's going to the bank agrees to these records that they dealt with to say how much cash there was. And bank recs are going to be one that we look at. So various ideas around cash receipts, just ways to control this. When it comes to cash payments, the same idea exists, just different controls. So assignment of responsibility and authorization is in place, where only authorized individuals have access either to cash or can sign checks or can actually approve electronic payments. So when it comes to check signing, a company needs to decide which individuals are authorized to sign checks. And they tell the bank that, they give them a signature so that the bank can check to make sure only those people are signing checks. And typically you have 2 people needed to sign a check for a business, because then it's helping with segregation of duties, where 2 people are looking at that backup and signing the check to say that it's accurate. Same thing with electronic payments. The company decides who is allowed to make these. They'll get some sort of code or password to log in. And you typically need 2 people to do this as well. So one person sets up the electronic payment, and then you also need a supervisor or someone above that who can then release it. So again, different levels of authorization and also segregation of duties where 2 people are looking over that item. So we talked about those levels of segregation of duties, but you also want to have the CAR, so different people who have custody, who have authorization, and who can record it. So whoever's actually taking the payment or has cash and the checks, they're one person. So someone prepares a check or an EFT. Someone else needs to authorize that, so sign the check or actually release the EFT. And then another separate person would be the one to record it in the system. Because at each level, they're going to have documentation that they review. And if one person does something wrong, one of the next people in the process will recognize that. So it's preventing and detecting if there's any errors or fraud. Documentation. Some examples here are pre-numbered checks. So when it comes to cash payments, it's rare that a business will actually pay with bills or coins because there's so much risk. They don't want to give this to someone, say, go to the store and buy this. There's risk they could take that money. So checks and EFTs are far more common for cash payments from a business. So pre-numbered checks, that means that if one of the checks, a check number is missing, someone would look for that. So why isn't this recorded in the system? Did somebody steal it and take money themselves? So you're able to track those pre-numbered checks. You would need invoices, purchase orders, things like that. So I've gone through in this next slide, I'll just let you guys read this over after, but it looks at a lot of this process and different documentation that would be in place. For physical controls, you would store cash in a safe. Only certain people would have access to checks. If you have EFTs, only certain people would have access to the different software or machines needed for that. So you don't allow people who aren't authorized to have access to these goods. And then review and reconciliation. So you'll compare a check. If a check is prepared, it would be prepared for a certain invoice. So you're reviewing and comparing the check to the invoice, and this would go through this process here. So one person gets the invoice, prepares the check, somebody signs it, and then eventually it gets recorded. So different reviews here as it goes through that process. And then the bank rec, which we will look at. So as I said, I went through this Boyd the Auto Body Mechanic, and I've broken down a common process that would actually be in place for when ordering and payment of items needs to be done. And I've noted under each part what type of controls that these are having. So I'll let you read this on your own. It's just another example of where controls could exist. So when it comes to cash, the use of a bank is another type of control. So it's a safeguard because you're actually depositing your cash into that bank, and therefore there's less cash kept on hand. So if you get to take it to the bank every day, there's less cash that you have at your location and less chance of theft. But the bank is also what they would call a clearinghouse or a reviewer for checks. So when you write a check from a business and you give it to somebody and they cash it, that eventually goes back to your bank and they would review that check to make sure it has the needed signatories. So if 2 people need to sign it, they would check to make sure there's 2 signatures, and they review the signatures compared to what they have on record to make sure the right people are signing the check. So the bank helps as a safeguard that way. But they also provide 2 sets of records, or they are providing this second set of records. So the first set is the one by the business. So these are the accounting records. So when cash is actually paid or received, we know a journal entry is done to record that. But then you can also compare that to the bank statement, which is a set of records by the bank, which is telling what goes into the bank and what comes out. So you can do a comparison, or what we call a bank reconciliation, to look at these 2 amounts and make sure that we know why there's a difference if there is. And that is what we will look at for the rest of the chapter in these next videos.